So let's turn now to Beth Ann Bovino for more on today's jobs report and what it could mean for the Fed and the economy. She is the chief U.S. economist at S&P Global Ratings. Nice to have you back with us.
Great to be here.
Give me your take on the jobs report. It was a little softer than what the street wanted, but wages were good.
Well, there's a couple of things to factor in. One, it was a little bit softer, but August is a very tricky month for a couple of reasons. One, all those kids that have those summer jobs, well, they leave and they go back and they go to school. So you start to see jobs go away just for that very reason. Second thing is a lot of those forms weren't filled out. A lot of business owners were also on vacation, so they didn't get around to filling out that form to send to the Bureau of Labor Statistics. What we'll see is probably in September those forms will be sent a little late, and we'll probably see those numbers change, and most likely to the upside.
I mean, we have to keep pointing out this is still a very strong labor market, still a very tight labor market at this point. Is this slowing, though, enough to convince the Fed to want to cut rates this month?
We look at this report as sure the headline numbers, those scary headline numbers. We finally don't see that 200,000 job gains that we got used to are a little scary, but we see the underpinnings of this report is rather good. You talked about wages. We talked about something that wasn't mentioned is the work week now has gone back up to higher levels. That's positive. That means businesses don't need to basically aren't putting people on furlough and will probably keep people on their books. That means that in our mind that the Fed could probably wait, given that the jobs market is relatively strong. We don't think they will, though, largely because of pressure from what's happening with the with the trade war and other reasons. The Fed will likely move most likely in September.
Does this report kind of take away those fears of recession that we were talking about not just 2 weeks ago? I mean, do you see a recession on the horizon?
We see unfortunately, we do see recession. The risk has increased. Now, it's not at that point where all batten down the hatches, but we do see the risk increasing. We have raised the risk of recession going out 12 months to close to 35%. To put it in perspective, a year ago it was 10 to 15, so it has increased pretty sharply. However, that said, things can change, and the Fed, indeed, in terms of them moving on, basically adding more liquidity into the markets, lowering rates, making it more attractive to borrow and to buy, and the domestic side of the equation is holding up relatively well. That could give us a little bit more cushion as we kind of go through this uncharted territory.
All right, Beth Ann Bovino with S&P. Thank you so much.
Thank you.